Hello, everyone. First of all, wishing you all a very happy and a prosperous New Year 2023. Thank you all for joining us today. I am Ashya Khosla and I'm part of Institutional Equities Research Team with Yes Securities. As you all are aware, that today we'll be discussing wealth creation with mutual funds. Sounds fun, right? Great. So by the end of our session, we hope you will have more knowledge on mutual funds to be considered as one of the instruments for wealth creation. We are very passionate about today's agenda and have many exciting stories and learnings to share with you all today. So, not wasting much of your time, let me quickly introduce our guest speaker, Mr. Asit Bhandarkar, Senior Fund Manager, JM Financial Mutual Fund. He has a rich experience of about 2 decades in equity research and fund management and has previously also worked with Invesco AMC, SBI Funds, Jet 8 Securities, and Sushil Finance. Thank you for joining us, Mr. Asif. So before we proceed further, for our audience who is watching us live, if you have any questions during the webinar, please type them into the chat window. We'll address them during the question and answer at the end of the session. Over to you, Asif.
Oh, thank you very much. And first of all, extreme apologies for this delay. Not the best way to start your first webinar of the year. But anyway, Happy New Year, guys. Hope the year will be better than the last one. Before I jump in to the PPT that I have some few slides, I think it's last year has been a difficult year in that sense, right? I mean, there was not a lot of good news. We started the year with the first quarter and there was a war, and suddenly, the world turns upside down. Whatever we thought, held true in sense that, we are entering a new digital age. Oil and old economy is passe, but suddenly oil became very important. Oil ran from 60 to $120. Things changed dramatically. uh, uh, Something which we took for granted, which is cheap money, so much activity in private equity, virtually very sky high valuations for startups. Everything changed. We've seen how the year has ended. I remember in the last year, at the same time, had we been speaking, we would have been speaking about how well some of the internet and innovation startups have done, how well Tesla has done, how one of the funds which bet on all these ideas globally, called Arc Innovation Fund, in a matter of 7-8 months it went up 3x. So that was a context, and how the next year has been. So I think we all learn from history, and I just wanted to place a few slides here as to how we can interpret what has happened in recent past, and how we can sort of take lessons from it for the future. But biggest point, I think, is India sort of investable? What is the opportunity? See, in real depressing times is where you make your best investment opportunities. This is what we have seen in the past, that when things are down, when the world gives up hope, is when your best ideas come to you. Maybe next 6 months is the time where we will have some volatility, but we will also have some of the best ideas. And for see, sometimes lot of things that we intend, that make big money in the capital markets are very, very visible. They're around us. There's a lot of common sense behind them. It's just that in all the noise, volatility, we just miss them. So, Arshia, with your permission, I would like to go on and show a few slides to your audience. So I think this slide sort of puts in context. This is 10-year performance of all asset classes. This the GSEC yield is about 8% on a 10-year basis. Gold would have given you about 6%. Inflation, now, since the topic of the webinar is wealth creation, the one of the objectives of investing is to beat inflation. And as you can see, if you had invested in the Nifty over last 10 years, you would have beaten inflation quite handsomely and created very strong returns. By the way, we all know and understand that our Sensex and Nifty are in a way a reflection of how well our economy is. But you'll be surprised that during this 10-year period, Indian GDP has grown by, I think, 5.2 or 5.6%. Even adding inflation and looking at nominal GDP, it's around 10%. So Nifty investment and BSE fund, which is equity investments, definitely have given us that extra edge in creating that wealth. And uh, mutual funds, that is, we aspire to beat these indices. So it's for so our job is to create more wealth than the benchmark indices. How do we do it? Just wanted to just what is our process? We have a very seasoned team. Like, see, lot of money was made in the year before. Small caps had rallied. People had made a lot of money. You went to a marriage and everybody said, yeah, take this stock, and it went up next day. That phase is over. It's a difficult phase, and this is where the differentiator of investing through a mutual fund comes through, because we have very solid processes. This is for us. So what I'm placing in front of is actually for JM mutual fund, but it can be different for different fund houses. But I think what is common is that most fund houses have in-depth research. They have very large team, which seasoned team. We have a team where our experience is we have seen a taper tantrum, global financial crisis. In fact, our CEO would have even seen the LTCM crisis of the past, etc. So very our understanding of risk becomes very important. What does a correction teach us? It teaches us risk. Reward is what a bull market teaches us. So we have seen that. More importantly, I think we have access to the management. Our processes ensure that we do much more than just read an annual report and rely on public information. I think, see, 20, 25 years back, getting some data on the company itself was difficult. Today, once the result flashes digitally, all ratios are calculated, everything is available. So information is out there and it's commoditized. So analysis beyond numbers is what earns us our bread and butter, and that's what we focus on. Okay. Some of the interesting things, that we just did some study. Why should somebody put money in a mutual fund? Because of this study that we do and the process that we do, we are able to capture the early winners. And this study that is in front of you actually shows you that's a big part of the return is captured when a stock is small and not identified by a lot of people, when it is not in the Nifty, when it is not in the large indices. So this slide in front of you shows that if you took the base date of 2012 and invested in some of the stocks, a stock like SRF, for example, would have gone up 66 times in the matter of 10 years. Okay, and by the when by when it crossed 30,000 crore market cap, which in our opinion becomes sort of a large cap. And after it's become large cap, also it's given 94% return. But my point is, a big chunk of return has been made there. Let's look at some other examples. Berger, for example, 12 times return, 1200% return till the time it touched market cap of 30,000 crores. And after that, it has given you negative 22% return. Info Edge, the parent of Zomato, okay, solid returns, 10 times returns in a matter of what, 7, 8 years. December 19, it crossed 30,000 crore market cap, and after that, what, minus 12% return. So my point here is that you have to capture the compounding, and that is what our theory is, that do research, find out these themes initially. By the time an info edge is known and it's in the Nifty, it would have given most of its return already. And hence, mutual funds, with our own research and with our own backing, with our own backend, with the kind of analysis that we do internally, and the kind of money we are able to spend on this particular activity, money, time, effort, and the processes that we have to manage risk, that ensures that we kind of give you little better returns than the indices. you know there are a lot of stocks which could have given you these kind of returns for a brief period, but what ensures that these some of these stocks continuously give you 10 year plus kind of returns, is the fact that their balance sheet is very strong, they have very low debt, and there's solid cash flow generation. We track these things. We just don't go by just the profit number. We go into the depth of what is the quality of profit, what is the quality of business. We go and cross check what kind of sales these guys are doing, what kind of back end sales that these companies can do, what kind of balance sheet that these guys can have next year and year after. Our projections end up doing that. So our job is to capture this, and that is how we hope and pray that our returns come. Now in this context, what can happen in the next 10 years? We've seen a lot happen in the last 10 years, double digit returns in the index. What should an investor expect? We feel that India is sort of at an inflection point. It's a very rare point in any economies, in economic history of any country. Just wanted to highlight, two slides at the bottom here: South Korea and China. If you see South Korea in 1983, they touched a GDP of $2,000. India has touched $2,000 this year, by the way. That is the context. Okay. In 1983, South Korea touched $2,000 per capita income, and in the next 10 years, the GDP grew at a CAGR of 15%. We said, oh, this is a very small economy, small geographical economy. Let's see how a large economy does. China is an economy which is larger than us. They touched $2,000 in 2006. What has happened after that? 14% CAGR returns in per capita GDP. And why does this happen? Because, our analysis suggests that till $2,000, most of the income of a person goes into what, we can call in Hindi as roti kapda makan, your basic essentials. When you start making money, you want food, you want a secure place to stay, you want clothes. But all this gets taken care of at around $2,000. In fact, if you just look around, you will start realizing that how gradually luxury consumption, aspirational consumption is picking up. Have a look now. I think pre-COVID, we used to say that India is going to be a small car capital of the world. All our ministers used to say that, and globally, all companies were coming and building a car for India. Today, there is no waiting period for a small car. But if you try to go and buy an SUV, there is a waiting period of 6 months or 8 months. One evidence of aspirational consumption. There are a lot of such evidences that you will see around you, where gradually consumption has picked up very sharply, aspirational consumption has gone up. Why? Because gradually, as people have crossed that roti kapda makan hindrance, they have moved into luxurious aspirational consumption. We will see very different set of businesses start to do well from here. We if you see our Nifty today, you would see cement companies there, we would see steel companies there. I'm not sure if after 20 years, if we look at a Nifty, those companies might be there. You go and see how a Dow looks, developed economy. You will see that there is the substantial amount of market cap starts moving towards businesses which are linked to consumer discretionary spends and aspirational consumption, and that I think is the biggest trend. So today, if we are going to invest in companies which did well in last 15 years, we will make decent money, because these are companies where balance sheets are strong, everything is going on fine. But the big wealth will be made elsewhere. We have seen this in the last decade in certain companies which are in retail sector. You know, on one hand, one famous retail company collapsed, but on the other hand, a Tata Group backed retail company has done phenomenally well. A jewelry company, phenomenal returns, and there is no end, because they are still entering tier 2 towns. India has there are jewelry shops right down to villages in this country, and everybody loves jewelry, isn't it? So what we are seeing is that annual household spending share, which was largely, if you see in this table in front of each other, chart in front of you, 2005, 15% went to discretionary. 80% plus of 85% plus was in essentials. Now, as you go into 2030, you are going to see 40% going into discretionary, and that means that there's massive growth in these companies over next 10 years. And one more interesting thing I think I must tell you, we took 75 years here to reach $2000. When the next $2000 is coming? In the next 6 7 years. So the wealth that we've generated in last 75 years is would be generated in the next 7 5 7 years. In fact, look at the center chart here. You know, the retail market size that exists today, you know, and that will exist in 2030. The current market size is less than the growth that you will see in the next 7 8 years. So that is the extent of growth that is there. So very different businesses. There are a lot of demand drivers quite clearly. I think what is clearly going to accelerate these things is the fact that we have an e-commerce ecosystem in place. India had a lot of problems. We could not. The geographies were large. We couldn't go. Traveling in India is very difficult. For electricity was not there. A lot of issues. Now, gradually, phygital has become the thing. There is physical on one side, there's a digital on other side. There's aspiration everywhere. Everybody watching the same shows on OTT because of 4G. And if somebody sitting in a village wants to buy a Revlon lipstick, they can order on Flipkart. I think that is changing the game totally. Earlier, we would have money in the villages, but they had no avenue to spend it. Now that money is also coming. So e-commerce is also going to help but this particular thing. And more importantly, e-commerce of course thrives on digital payment ecosystem. I think that is all happening together. Now, where are we as an economy? If you take a stock, we are of course the world's fastest growing economy last year. But even otherwise, I think on a global rank basis, agriculture we are number 2, industry we are number 5, services we are number 7. And all this, believe it or not, in next 5 7 years we might be everywhere in top 5 or top 3. We feel that we are at a J curve kind of a consumption effect in the next 3 years, in next 7 6 7 years. And $2000 has been a very important benchmark that we'll cross here. We feel that we are in a virtuous cycle right now. We have higher GDP growth, like we said, high fastest growing economy. That leads to higher savings. We are all seeing how mutual fund industry has grown. We have seen how demat accounts have grown in the last 2 3 years. Government is collecting higher taxes. We are getting better infra. Look at the project sizes that government is imagining. We had one expressway in this country. Now we have so many express under construction, right? And finally, when they collect more tax, higher income leads to higher consumption, because government spends on a lot of things. It generates more employment, and it becomes a cycle of wealth generation. So I think this is what any investor who is looking over the next few years should focus on. Because see, we are in a volatile period now. It is easy to get unnerved, be afraid, lose your nerve and say it will not work. Equity is volatile, we don't want this. But uh, but the fact is that if you don't lose your nerve and you continuously get exposed, this is the kind of wealth creation opportunity that we are going to be seeing. Also, I think one point I have put all these pillars of growth. I've already discussed consumption, we've discussed bit of savings, how demat accounts have grown 2x in last 2 years, etc. But I think one new factor that we are seeing is, and thanks to COVID and China, we are seeing China plus one. We are sort of seeing a manufacturing renaissance in this country, a revival of manufacturing. Manufacturing pretty much dead, right? Even our Diwali candles and lights came from China. That is the situation we were in. Now we are on the verge of becoming for certain engineering factory for the world, for certain engineering products. Maybe it is all luck, or maybe things are just fallen together. But in last 5 7 years, government also took a lot of steps. They took steps like corporate tax reduction. They brought down corporate tax quite sharply. In fact, for a new plant in this country now, you pay only 15% tax. They also went proactively and protected domestic industry and made sure that our balance sheets are strong. So today, when everybody wants to do China plus one, Europe plus one, our companies are in a very strong position to go ahead and participate in this. The benefit of this, how much, it's too early to say, but government is now incrementally given a PLI scheme, which ensures that if there is any doubt in your mind whether I should put a plant, not put a plant, I will give you some incentive. Go ahead, put a plant. So that is the kind of pillar of growth we are now getting into. I already discussed this, but on a dollar basis, last year we are negative. On a rupee basis, small cap index was, if we are in local currency, if we see this is on dollar currency, because this is how it is in terms of dollars globally. This is how any US investor would see our performance. But I think on a domestic basis, we are at about 4% positive on the Nifty, and small cap index was about 2% negative. And look at the kind of outperformance we've had versus others. Say something like Nasdaq, 33% down. Whole of Europe battered. So we are in a very unique situation for next year. The situation is this: that we are not bad, we are quite good, but others have become just too cheap. So, from a new investor's perspective, it may make more sense for them to look at, say, because see, last year there was war, so the base of European economy would be very low. China was in a hard COVID kind of era, so their base is very low. Plus, they had a property burst. Now, when you look at their growth on that base, they may look to be growing faster, and who knows, their markets have also corrected. So there it's a possibility that these companies look much more attractive. These countries look much more attractive to us in the short term. But believe me, next, if you look at the long term, India still presents one of the best opportunities in terms of demographics. Like for example, we just read a comment there saying that India is the second largest workforce in the world. You know what it means? After 25 years, all these 30-year-old guys are going to become senior citizens. Right? That means they're going to need hospitals. Sure, short growth. We may be wrong on everything, but they'll need healthcare, they'll need hospitals, right? So this is the kind of opportunity demographics is presenting, and these businesses are going to be very large. So long term, India is going to be very attractive. Our point is here that don't get unnerved by short term. Short term volatility is there. This looks expensive. When you look at the chart on the lower side, pardon me, I think the chart on the first chart on the left is not proper, but if you look in the chart on the lower side, it shows the yield of Nifty versus the yield of GSEC, you know, which means that today, the yield of Nifty is actually negative versus GSEC. It makes more sense to put money in GSEC after interest rates. That is right for now, but that does not deter a long-term investor, because we have seen what kind of returns an equity investor can generate over the last 10 years. That is the point I had to make. There will be volatility. Please understand the chart on the top right here. This is a this is a this is a 13-year chart, a 14-year chart of VIX. VIX is the volatility index. Blue is the US volatility, red is Indian volatility. If you see, this is what we call as direct correlation. They're directly correlated. If we think that India is superior, we'll be best, nothing will happen to us, doesn't happen. We are always going to be connected, and now so more connected with the rest of the world. So we will be as volatile. If Dow falls, we will also fall, maybe less. If Dow goes up, we will also stabilize. We may not go up, but the direction will be similar. Extent will depend upon us and what things change. So we have to be cognizant of that. I'll skip all these slides because these may not be too relevant right now. I'm just sorry, I think there's some problem with the display mechanism here, but I'll just tell you about the valuation right now. Currently, if you see, as on FY23, the PE of the market, there are these three bands. The upper band here, we can't see clearly, but I'll still try and verbally explain. Uh, at the current band of blended forward, this month's earnings plus next year's whatever projected earnings are that we see, Our markets are now on the Nifty trading at the upper band of valuation, which is 22 times. Okay. Uh, what is the right point to invest? At about 19. That's where we are at the average. And what is the worst case that has held through in the last 10 years is 16p. So now, if you are an investor who is looking at next year's earnings, if this is the projected earnings on Bloomberg, 1,000 rupees is the earning for the Nifty, that would mean that if today, if you're really afraid what can happen to the market, index has a probability of going to 16. But should you wait for 16? There's no guarantee that it will come there, right? Uh, this Nifty we are speaking of, right? So we can have a 5-10% correction from where we are. That is what our view is, and it can be volatile for the next 6 months. That is also what our view is. But it should not be you should not be afraid. Any long-term investor should look at the longer-term opportunity that this market presents and try to focus on the long term, because the kind of growth that our economy is going to show is going to be phenomenal. So I think broad takeaways before, I think, we can probably, Ashia will have some questions, I'm sure, plus, all of you. So our valuations at a premium. Just summarize here, okay? Economy is on a strong footing. We can see that tax collections are fantastic. Corporate sentiment is good. We are seeing a lot of companies go out, put up large plants. MNCs come and put up plants in India. Sentiment seems to be very good. If you look at asset quality of PSU banks, they're the cleanest in the last 10 years. We are seeing, virtually zero NPAs coming through. Both on the retail side. COVID, of course, was a difficult period for some certain business like small finance banks, etc. But even there, we are seeing very strong revival of their fortunes. But yes, what also happens is that as interest rates go up, certain amount of people will start looking at other asset classes. If a bank FD which was at 4% was not attractive, at 8% it may look attractive to some people. A senior citizen will say, why should I take the risk of equity? They'll move towards that. So some equity flows will come off, and that will have its own effect in the way markets will trade. Our markets are at a premium to emerging markets. I've already explained how, some money may go to other economies. Europe will look very cheap as compared to India. Some money may go there for 6 months, but after these valuations catch up, then when they compare the growth, our growth would be much superior. So after a volatile first half, I think, for a long-term investor, clearly, India would remain a very attractive place to be. And I think that is, I think, the basic point that I wanted to highlight here. Maybe, Arsha, if there are any questions, we can take that.
Great. So thanks a lot, Asit. Obviously, we completely understand that people are moving towards premiumization, and as per you, there's going to be some volatility, and the markets are going to be a little choppy in the near term. But yeah, India holds its potential, and the long term is obviously great for India. So till the questions line up, let me just go through a few questions that I have for you.
Sure.
Great. So, just wanted to check that, growth or value, what should we play in 2023?
Ah, it's a question that we keep debating in our office every day. So you touched a on out there, but I'll tell you very frankly. Okay, see, India is a growth economy. Okay,
Absolutely.
there is no shortage of growth here. If we just we do research and we look at BSE 500, we get so many companies which grow at 15% plus. You know, I mean, if I want within the BSE 500 index, there may be at least 100, companies which grow at more than 15% plus. That is what our objective is, right? 15% plus returns. So, we are biased as a fund house. We are growth focused. Okay, uh, we, but at the same time, we are not going to buy growth at any price. Okay, we prefer we keep our eye on valuations. See, market has its nature where they go into excesses. You know, we discussed the dot coms, not dot coms. These all startups. You know, the kind of valuations people got listed at. Once there is sanity, maybe some of them are very investable businesses. Similarly, I think what we have to see is that we have to have that fine balance between growth and value. We if we put every if we put the whole basket into value today, we will lose the long term opportunity that, say, a big jewelry company or a big retail company is presenting, or a auto company is presenting, because those are not value stocks. But should we be so negative that we say forget everything, let's look at dividend yield, let's forget growth? No, not at all. I won't think so, because if you should not be doing that in the world's fastest growing economy, GDP. You can't be doing that. So I would say that we have a bias for growth, but yes, we do watch out for craziness in valuation. We prefer to invest in companies with saner valuations, and that is part of a process. We have an internal process which weeds out insanities, which weeds out balance sheets which are not great. So if company has a lot of debt, we automatically don't invest in it. So those are part of the checks and balances we keep in place to, just to put a long answer for a short question. Sorry.
Understood, understood. Growth, but with values, with proper valuations. Yeah, great.
Fair
Okay,
price. We are willing to pay a fair price.
fair, absolutely. So, yeah, we have a question lined up. So, how do we plan mutual fund investment to ensure both immediate expense and future investment goals, are met in reasonable time frame?
See, this is a different science. Frankly, I'm a fund manager. I invest into stocks to generate wealth. But this question should be more directed towards a financial planner. They can advise an individual very well on goal-based investing, etc. Okay, so it's a big science because it's a mix of what your age is. It's like this. Today, if I want a goal based planning for myself, I would also go to an investment planner, because otherwise I am an equity guy. I'll want 100% to be in equity, right? But when you look at this planning and the question context of the question, okay, see, this advice is very easily available today, digitally also. And people like yourself, yes, etc., can definitely advise you on this particular matter. uh, Mutual funds are a vehicle to achieve that objective. The objectives will be decided by you and the financial planner.
Right. So, yeah, we have another question. What is the worst case scenario for India's long term proposition? So he wants to ask that what factors could pose a threat to our value prop, and how should we proactively counter them at government level and at corporate level?
See, I'll tell you, it's very difficult because it's a very hypothetical question. What's the worst case scenario? Who knows? But can you put my slide here? I have just put one slide here. It may just put things in context. Yeah. See, this is 20 years fluctuation, Nifty high, Nifty low, and what is the fluctuation? In 2000, Nifty low was 1100. Today, in 22 years, our high is 18,888. Okay. And what is interesting is every year there is double digit fluctuation in the Nifty. Okay. So, so what do you want? I mean, if I want to give you a range, 2008, it was down 65%. Okay.
Absolutely, yeah.
Or some, so there is double digit thing. Well, volatility is going to be there. My whole objective here of showing that slide was that don't be afraid of volatility. Make volatility your friend. In fact, what the mutual fund industry has been tom-tomming, sips, What does the SIP ensure? That if the market is down 20% volatile in the whole year, you invest every month and you get an average. So you're better than the guy who invested at the top. You're not as smart as the guy who invested on the bottom, but you got a better average return. So I think my advice would be that, the worst case, I think, the demographics and the way our GDP is structured right now, the way digitization has happened, I think it's less, time to worry about the worst case, but it's more challenging here not to miss out the best case. Now, I'll give you some
Great.
small numbers, which are startling. Uh, Eating out habits in this country. Okay, Thailand, people eat out 22 times a month. In India, it is 2 to 3 times. Where do you think it will be after 20 years?
Absolutely. It's a huge difference as of now. But yeah, we'll be reaching that number. Yes. Clearly answered. So let me put forward my second question. Can we get a few themes or maybe sectors to ride the uncertainty of markets?
See, our theory in this is that, follow the profits. Wherever profits are and valuations are reasonable, the impact of volatility will be least, because, I will sell bad news. I will not sell good news. Right? So from that perspective, for this year, clearly, if you see what has been going on, I think BFSI has been a great source of profitability for our indices. Beyond their weightage, BFSI has been, and we sort of are quite okay with it. Another thing we have seen is that manufacturing companies are continuing to surprise across, engineering. So these companies were actually not, in fact, you will be surprised, no engineering company was in the Nifty. One of them is a large cap. Such was the situation with manufacturing in this country, and we are finally seeing them on a very strong growth trajectory. So if you really press me, I think these are the two sectors where we clearly see chances of disappointment are very less.
Right.
And that's, if you see our portfolios also, that is our choice to ride out the volatility.
Okay. Understood. Great. Got it. So we have a question lined up. Do you
Yes.
see tech economy scripts listing on Indian bourses? And there are a number of VC funds seeing exit from public markets.
Well, they are. I think, like any investor, if we put money in equity market, we want to make a handsome corpus on our retirement, go on that holiday, enjoy our money. Well, VC funds also represent that kind of investors, so it's fair that they should exit. And they deserve an exit because they bet on very uncertain businesses, went through tough times, in fact, in certain tech companies, digital companies. I would think this question is more for digital kind of companies, startups which have got listed over last few months and may list further in future. So yeah, these guys are exiting. That's fine. I don't think we should be worried about that. The companies will want to get listed, yes, but I think these companies won't get the valuation that they got last year. We have seen how a lot of these companies have fallen 50, 60, 70% from their issue prices, and maybe are finding a reasonable valuation here. So if any tech company comes at reasonable valuations, then we would be happy to look at them. By the way, I mean, I just want to put things in perspective here. We as a fund house in last 2 years avoided all these IPOs. We did not invest in any of these IPOs, any,
Great.
because our process prevented us, because there's a valuation matrix we follow. It didn't fit into it. But if they were to fit into it, we might happily invest, because see, the fact is that some of these businesses are are great businesses from that perspective. Uh, you know, they are backed by young entrepreneurs who have a very different way of doing business. Second, all the digital backbone we spoke of, the Aadhaar based authentication we spoke of, a lot of things these guys have been able to imagine, reimagine much more. You know, even broking business for that matter. You know, today the largest share among brokers is actually a startup, right? Because they could think and imagine that trading will happen on the phone. You know, most of us couldn't. So you know, these guys can think, and that is there is that premium that is there for being the first and ability to think and to execute. Valuation is a different game, so we'll have to take that context on every company when it gets listed or it comes up for listing.
Right. Got it. So obviously valuation is a concern for such IPOs coming up. Great. Yeah. So let me put forward the next question. So there are a lot of IPOs coming in, say, cosmetics and D2C consumer businesses. So what do you say on that? I mean, can we have a view on those IPOs? And I mean, how do you see the valuations for them?
See, I'll tell you. You know, we have had D2C IPO getting listed, and you know they were the only profitable IPO which was there, and they did okay. You know, post listing. Of course, not from the peak price. Everything is corrected. But see, my point is very simple. Okay, there is a play in from what I have discussed is there is definitely lot a play in aspirational consumption. Okay, there is no longer money to be made in toothpaste and soaps. Okay,
Right.
but a body wash, yes, and then some, you know, premiumized body wash, yes. Now, how can you do this business direct to consumer profitably? Because who are standing in front of you? They are global MNCs. They can also launch these things, right? And they can do it much better. Why will a consumer you know take your product versus somebody else's product who's much bigger, has far better resources, has a big supply chain? It's a challenge. It's not impossible, right? It's a challenge, and it's an execution challenge. So we have nothing against some of this. In fact, we would be very happy because, you know, we are so bored of FMCG companies who grow only at 10%. I would also be very happy to have a FMCG company growing at 30-35%.
Right. Yes. That's something we look forward to, of course.
Yeah, we want it, but at our price.
Right. That's also there. Absolutely. So, probably moving to some other asset class, how do you see gold this year?
That's a tough one because gold is typically would be considered as an inflation hedge. If you see very long term, in fact, 10 years it's not done so well, but 15 years, I think the gold CAGR is as much as the Nifty. But so that makes housewife as smart as Nifty and equity fund managers.
Absolutely. Housewives are
But
anyhow smarter. Yeah.
but that said, you know, I think see, one of the biggest currency depreciation is also captured in gold. If we look at gold price globally in dollars, it's not been such a great performer. It's because our rupee has depreciated over the years. Now, what we have to see is, in future also, do we see rupee depreciation to the extent that we have seen in the last 20 years? If that does not happen, and by chance rupee appreciates, gold has a global price, we may not get a great return. So it's very difficult. As an equity fund manager, I'm always biased. I personally feel that equity is the best asset class. We look for companies which grow at 15% plus. There's an outside chance that gold may give you such returns. Whereas our fortunes are more linked to what we can see the balance sheet. Gold is very difficult to predict. There are a lot of moving parts.
So yeah, can we get a few funds that people should invest in, looking this year, like this year perspective, or maybe a long-term perspective?
As I said, there's no, there's no one answer to this, because what is suitable for one investor may not be suitable for another investor. If there is a 60-year-old investor, his goals and objectives will be different, and a 25-year-old investor's goals and objectives will be different. Second, everybody's needs are different. Somebody wants, if somebody doesn't, somebody needs capital to buy a house, so he may want to withdraw in certain period, so his goal may be less. Somebody does not want money for 20 years. Somebody wants to make sure that his money gives him returns every quarter. So, there is no one answer to this. And as I told in the earlier question also, please take professional advice. In this country, professional advice, certified planners advice is very cheap. Do consider taking it. They are the best people to advise you. As a fund manager, I will have my own bias, and I'm an equity fund manager, so I'm not the best guy to invest.
Understood. Yeah. So it depends on the needs of a person, like probably a investment horizon and things like that. Great. So someone has a question that in a study that came out that 90% large cap mutual fund schemes are not able to beat the Nifty returns. So any like he wants a suggestion on any mutual fund that is going to do better as compared to our benchmark index.
Yeah, no, I think that's a good question actually, and that's very topical question, well studied question. So I, I will answer this. So see, the fact is this, that large caps are very few stocks. First of all, there are so many stocks listed. Large caps are few stocks, and it's a global phenomenon that large cap mutual funds find it a little difficult to perform. That's a fact, because there are fees also that we charge, and movement is also so narrow in large caps, so it may be difficult. But I think the good news there is 10% are outperforming, so you can look at the 10% right away. Other than that, I think, see, the point I was making, in a country like India, where is the money to be made? Money to be made is in high growth businesses, which probably may not be available in the large cap segment. So there are funds, which say for example, flexi cap funds, which let you take a blended approach to, you don't invest in large caps alone. If mid caps are doing better, small caps are doing better, do invest in that kind of a fund. Or funds which are looking at mid cap universe by itself. So it's a higher growth trajectory, but clearly, right, you can understand that a smaller company, may, it's like, for example, let's just give an example. I gave an example about how many times people eat out in a month, right? So a QSR business, quick service restaurant business, probably has much more growth than a soap making business. Now you will find soap making business and toothpaste in the Nifty. QSR you will not find in the Nifty. So my point is that, if you want higher growth and you want outperformance, yes, I think you should consider these kind of funds, which invest in mid caps, which invest in the themes, or which are flexible like flexi cap. So they will go up and down wherever the opportunities are. I think you will get much better return in these categories. PMS and AIF, believe it or not, if PMF and AIF also invested only in large caps, their returns might also be similar. So they do take extra risks. So it's not an apple to apple comparison. In fact, I think you should consider the fees that you're paying there and the taxation.
Absolutely. Great. So let's begin for a minute or so if the question queue lines up. Yeah. So we have a question from someone from our audience. Do you advise diversification into equity, debt, gold, or go equity heavy in investments?
For anything in life, like anything in life, in investing also, discipline is very important. Greed is not a great thing. So you need to have asset allocation. What your asset allocation must be, either you decide or you with your financial planner will decide. That's one. But you have to be true to your asset allocation. So I would advise, yes, please be diversified between different asset classes. And real estate was not mentioned. And real estate is also asset class, by the way. You should asset allocation has to be composite and not just equity alone.
Understood. Great. Okay, so in recent times, we have seen corrections in all sectors. Do you think is there a right time to probably start? I mean, or should we wait for the budget to take decisions?
See, I tell you, having been in the market so long, no, and seeing the chart, the table that I showed before, 1100 on the Nifty in 2000, and today we are at 18,800 peak this year. There's never a right time to start. Yes, I think the second part of the question is, should we wait for the budget? Yeah, budget may give you some volatility. It may give you a budget rally also. I don't know. There are all kind of rumors which get which come in the paper, and who knows what if there is a pre-budget rally, you'll be buying more expensive. So I think my point was, every year there is volatility to the extent of 15 to 20% in the Nifty, which is why I think SIP is the best way to proceed. Don't wait for levels. I am unable to catch the levels efficiently, so I don't think anybody of us should attempt. Everybody will feel they can invest at the bottom and get out at the top, but in the long term, it doesn't work. We can do it once or twice or thrice in our life, definitely. But if you're investing, horizon or career is going to be 20, 30 years, it's not going to work every time. So the best thing is to be disciplined.
Right. Got it. Moving on to our next question. So, economy is largely driven by public expenditure, putting pressure on fiscal deficit. So, private capital investment in capex and infrastructure is very muted. So, basically, you wanted to ask that will this suffer overall GDP growth?
Honestly, I think, see, government finances have been improving. Post COVID, our tax collections have been fantastic, and whereas I would think that our government has been fiscally conservative. If you see during COVID period, US and all other economies, a lot of sops were given. People were given $600 a week in US, and a lot of benefits were passed on to the investors, whereas to the citizens, whereas our government had only given some rice and pulses to those who needed it the most. So we have been fiscally conservative. So government has not spent much, and we are now seeing that this being a pre-election year, government is picking up pace on spending. So yes, your point is right that private sector investment has not been forthcoming. In the infra space, but government, I think, will make a big push, and we are also seeing some sovereign funds and some PE funds also start look at this sector. Like for example, for foreign pension funds who need better yield, they will be looking to buy a highway in this country because it's profitable for them. It may not make sense to you and me. So I don't think funding is a constraint. It's just that the whole ecosystem was not so favorable, and it's improving every day, I would say.
Great. So, I think that was the last question for today. So, thanks a lot, Asit. It was great and a very informative session. So, we've come to the end of today's session, and we hope that this webinar was fruitful and worthwhile for you all. Thank you for tuning in with Yes Securities. We appreciate you signing in. This is Arsha Khosla signing off. See you all next time. Thanks a lot, Asit. Bye bye. Take care.
Thank you very much. Thank you very much. Thank you, Arshia. Thank you, everybody on this platform. It was a wonderful time answering these questions. All the best for the next year, and again, apologies for being late.
Okay. Thank you. Bye bye, everyone.